My name is Andrew Franklin. I'm a partner in the private client group at Bartier Perry, where I specialise in estate and succession planning. I'm also a proud alumni of the University of New South Wales. Joining me today is my colleague Belinda Chow. Belinda is a senior associate in the private client group at Bartier Perry, where she also specialises in estate and succession planning, as well as deceased estates. Today's topic is estate planning. The experience that Belinda and I have in estate planning is really very extensive. We've experienced many different client circumstances and dealt with a vast range of different technical and practical issues. What we have learned over our time in working in this area is that estate planning is one of the few times in your life that you will ever need to consider at the same time and as part of the same job, and in a great deal of detail, all of your family and personal relationship circumstances, as well as all of your financial circumstances. So it's definitely worth spending the time on this to get it right, because getting it right can make a really positive difference in the lives of your estate beneficiaries. And conversely, getting it wrong can make a really negative difference in their lives, particularly in terms of the delays that it might take and the costs that might be incurred in administering a poorly structured estate and dealing with the assets, the emotional stress of cleaning up a mess in a worst case scenario, and of course the time and cost in dealing with any disputes that might arise in the estate. Definitely something to be avoided. Properly planning your estate could be a complex thing to do, but it need not be. With the appropriate guidance from experienced advisors, the reality is that most circumstances are not too difficult to deal with, nor too time-consuming. But can I say it does help if you are focused on the tasks at hand, and if you can commit to the process. What we do know is that a very high percentage of the Australian adult population do die without having a valid will in effect. Or indeed they may die without having a will that is relevant to their current circumstances. Many, of course, have not considered the broader aspects of estate planning, including areas such as properly planning for superannuation death benefits, their own life insurance arrangements, dealing with private entities such as family trusts and family companies, enduring powers of attorney, appointments of enduring guardians, advanced health directives, and the like. Many of these issues and questions have been raised by the audience today prior to the presentation, and we're going to do as best as we can to cover off as many of those questions as we can during the course of the presentation and at the question session at the end. I suspect for many, however, when embarking on the estate planning journey, they just don't know where to start and don't know how to get to where they want to get to. Perhaps they're a little bit like this person in our next slide, who chose to live in a very unusual foreign jurisdiction, accumulated some assets in that foreign jurisdiction, and unfortunately sought advice from a very dubious estate planning consultant. I think things may have just got a little bit too much for her. A famous scene from Lewis Carroll's Alice's Adventures in Wonderland. "Would you tell me, please, which way I ought to go from here?" said Alice. "That depends a good deal on where you want to get to," said the cat. "I don't much care where," said Alice. "Then it doesn't much matter which way you go," said the cat. Now, unlike Alice, our experience is that in planning our clients' estates, most people in fact do care. They do want to look after their estate beneficiaries as best as they can. Also, they don't want to leave their estate in a mess for the executor and for the estate beneficiaries to clean up, but they would prefer for the estate to be transitioned as simply and as seamlessly as possible. They don't want family relationships to be destroyed as a result of a dispute over the estate, and they do want things to be looked after for the beneficiaries in the best possible way. Belinda, I might pass to you now. What do you think are the most fundamental things that somebody needs to consider when they're planning their estate?
Thank you, Andrew. Experience has taught me that critical to the estate planning process is understanding a few core things, being the family and personal relationship circumstances that exist, the family circumstances, and the objectives. The more thought that is given to these items and the more detail that is provided, the better, because they do shape the nature of the estate planning that is ultimately implemented. When we're looking at the family relationship circumstances, think about what your family tree looks like, but not just the immediate family. Think about relationship circumstances as well. In the relationship sense, it might be that you're providing some financial support to someone who's outside of your family. That's a relationship that you have with someone, and maybe that's someone who you would want to continue to support after you pass away. When we talk about the financial circumstances, we like to know how assets will pass on death. We need to get a fairly detailed analysis of what your financial circumstances look like. What assets are in your name? What assets are in joint names with a spouse? What assets are in family trusts? What assets are in superannuation? Is there any life insurance? All these sorts of things. And from there, we can then talk about some objectives that you may already know that you want to achieve, and some objectives that typically clients do want to achieve. Most commonly, having the right beneficiaries receiving the right assets at the appropriate time. It is critical to deeply think about who your intended beneficiaries are and what they look like in terms of their personal characteristics. Age, relationship status, family status, occupation, financial dependency, residency and citizenship status, commercial skills and aptitude, etc. These are commonly the sorts of beneficiaries that we might want to look at. Families, friends, dependents, charities, for example, University of New South Wales. Now, today's modern family can come in all forms, shapes and sizes. It would not always be the case that family relationships are quite as complex as the families in this slide, but it is always the case that understanding your estate beneficiaries and what they look like is essential to estate planning. Other than understanding who your intended beneficiaries are, it is also important for estate planning purposes to also understand their characteristics and circumstances, because this will shape how you prepare your estate planning. Things to turn your mind to include their age. For example, are they old enough to take and control their inheritance now? Their relationship circumstances. For example, is there a need to protect the assets against a family law risk? Their skills aptitudes. Do they have the ability to handle money and make sensible decisions now? Their occupation. Do they work in a role where they are at risk of being sued? Their residency. Do any of your intended beneficiaries reside overseas, or are they citizens of another country where providing them with an inheritance could lead to tax implications for them in their country of citizenship? These are all things that you need to consider. The same level of importance exists in understanding your financial circumstances. It might be that your accountant or wealth advisor can assist you in clarifying with some precision the asset holding position for your family. Each of the different asset holding structures depicted on this slide have their own specific planning points attaching to them. Assets that you own solely can be dealt with directly under your will. Assets owned jointly with another person or persons will require different planning. A jointly owned asset will automatically pass to the surviving owner or owners upon the death of the first owner, so you won't be able to deal with a jointly owned asset under your will unless you are the last surviving owner and you own the asset solely at the date of your death. Superannuation is usually dealt with under what's called a death benefit nomination. Depending on the amount of superannuation in your member account and your family circumstances, there might be benefits in paying this straight to your super death dependents, such as your spouse or dependent children, or it might be more beneficial to pay the superannuation death benefits to your estate and have it dealt with in accordance with your will. In relation to life insurance, it's important to understand who the owner of the policy is, who the nominated beneficiary of the policy is, and where you want the life insurance proceeds to go. For example, you might want these funds to go to your spouse so they can pay off a mortgage, or you may wish these funds to go into a testamentary trust for your intended beneficiaries. A family trust is separate to your personal estate and is not automatically dealt with under your will. If you have a family trust or family trusts, it is important to understand the terms of that trust, in particular in relation to who control the trust passes to when you die and where the assets of the trust are distributed to upon the winding up of the trust. Private companies and business interests. What happens to those entities when you die? Who takes control following your death? Are there any documents in place that need to be considered or updated in the estate planning process, such as shareholders' agreements and partnership agreements? Foreign assets. Do you own any assets overseas? what do you want to happen to those assets? It is likely that you will need to obtain legal advice and also tax advice in that jurisdiction in relation to those assets and prepare a will in that country to deal with that asset. The Australian will would need to indicate which assets are dealt with under the Australian will. All of the information about the family and personal circumstances and financial circumstances need to be properly considered in order to achieve the objectives that you want to achieve. This slide shows what we have to be the most common objectives that clients want to achieve with their estate planning. Making sure the right assets pass to the right beneficiaries at the right time. For example, Andrew, who might own an apartment in London, would want that apartment to pass to his son, Mitch, who lives in London, because that would make sense, and the apartment would not be of any use to Andrew's two other sons who reside here and do not have a connection with London. Another example is the client who has a child with a drug addiction. They may not necessarily want their assets passing directly to that child and may need to set up different structures and nominate different people to perhaps control a trust for the benefit of that child. Gifts to charities. It might be important to you that you continue your habit of making donations to charities in your will. For example, if you're in the habit of making a donation to UNSW, you may wish to continue that legacy in your will. It would be important to consider when these gifts are made, for example, when the first spouse dies, when the second spouse dies, or when both spouses and their children have all died. Asset protection is a common objective for most of our clients. There's the objective of protecting the assets against business risk. That is, the child or spouse who may be at a level of risk in what they do professionally, because they might be the partner in an accounting firm or law firm, and there is some level of risk exposure to them. It might be nice of them to inherit a large amount of assets, but it might not necessarily be great for them to inherit the assets in their own personal name because it exposes the assets to those risks. Family law asset protection is another common objective. This may be at the spouse level or the next generation level. At the spouse level, it might be an objective to protect the assets from the breakdown of a future relationship that the surviving spouse might have. At the next generation level, it might be to protect the children from any bad relationship breakdowns that they may have. You may wish to protect your assets from other personal issues or from possible claimants. Tax efficiency is another common objective. Testamentary trusts are a good asset protection and tax planning tool in estate planning, provided that they are structured properly. Testamentary trusts, unlike normal family discretionary trusts, are beneficial because minors are taxed at the normal adult marginal tax rates, meaning that no tax is payable on income distributed to a minor beneficiary up to $18,200 per year. They should be careful planning around superannuation, which does not automatically form part of your estate, to achieve the best outcome for your circumstances. Proper advice should be sought in relation to this to achieve your estate planning objectives. In addition, for some clients, these additional objectives need to be considered. Business succession, passing on the business to certain beneficiaries. For example, in the case of a family business where one of the children has worked there for their entire career and helped the family to grow the business, commonly the client's objective is for the family business to pass to that one child. In doing so, it is then also important to consider the interests of the other children who may not have been involved in the business at all. How do we provide for them in a way that is equitable between all the children? Situations like these need to be planned for carefully to reduce friction and conflict among the second generation. Are there any foreign jurisdiction issues? For example, some countries may have forced inheritance laws or inheritance tax issues. If you own assets in such a country, you may not be able to leave your assets to your intended beneficiaries the way that you wish to. Now, if you're the person with a young family, it might be an objective of yours to pay off the mortgage with, say, life insurance proceeds when you pass, so that your surviving spouse can look after your minor children without worrying that they won't have a roof over their head. At the end of the day, these are the most common estate planning documents that need to be prepared to properly implement the estate planning. Your will, superannuation death benefit nomination, review of the family trust deed and any necessary amendments to the trust deed, the enduring power of attorney. This is a document that deals with incapacity and appointing someone to make financial decisions on your behalf. The appointment of enduring guardian, This is the document that deals with incapacity and appoints someone to make health and lifestyle decisions for you. And remember, one of the greatest truisms of estate planning and deceased estates is, you never really know someone until you've shared an inheritance with them. Thank you.
Okay, thank you, Belinda. Let's consider the following case study. This case study is really designed on a fairly basic and very, very common normal set of family circumstances, something that we might come across all the time. We have a husband and wife, Fred and Wilma, and they have 3 adult children, Pebbles, Bam Bam, and Rock. All of their adult children are married people, and there's some grandchildren around. Pebbles has a son called Sandy, and Sandy has a sibling called Silt. Bam Bam has a son called Dusty, and Rock has a daughter called Ash. Now, one of the really important points that Belinda made earlier on in the presentation was for us as the advisors to get a really, really close understanding of the family circumstances. Many of the questions that have been raised by the audience today have dealt with things like, I'm concerned about my daughter's marriage. I'm concerned about my son's marriage. What if that breaks up? How can I protect the assets that I leave to them under my will? Or my daughter has moved to the US to live and she's married a US person and now taken US citizenship. What are the implications as far as the US estate taxes are concerned? One of the other issues that arise was, again, concerning children. My children is the drug addict. How do I best provide for that person? Or I have a disabled child. How is it best to provide for that disabled child? From our perspective, we need to know all of those finer details. So the family tree diagram is a great start, but as much detail as you can provide to us in the background information is really, really important for us, because they're all really relevant things as far as designing the estate is concerned. Now, Fred and Wilma also have some fairly normal asset holdings. Wilma is one of those high-flying corporate types who's a company director of many companies around the place and highly sought after business captain. For asset protection purposes, it may well have been the case that Fred and Wilma decided to acquire their home in Fred's name, in case Wilma got sued in some way, shape or form in her role as company director. So their family home is in Fred's name. They have various investment properties in joint names. They have some equities in Fred's name. Wilma has shares through an employee share plan, and they have a self-managed super fund that caters for the 2 of them as members. They also have a family trust that holds a chunk of the family wealth, and there's some loan accounts within that trust. So when we look at the financial accounts for the Fred and Wilma family trust, there's some debts that are owing by the family trust to Fred and Wilma. Now, those loan accounts may have arisen because of what's called unpaid present entitlements that exist, or they may have arisen because of loans that Fred and Wilma made to the trust at some point in time in order to fund the trust. Now, this set of asset holdings, not an unusual set of asset holdings at all. There's no values obviously put there, doesn't much matter, but the asset holdings themselves are not terribly unusual. As far as the objectives for Fred and Wilma are concerned, again, these are very common objectives. From a family law perspective, they want to achieve some level of protection in the event that one of Fred or Wilma die and there is a new relationship for the surviving spouse and that new relationship ends badly. They also want to achieve some family law asset protection for their children. As far as understanding the circumstances of the children are concerned, yes, we need to know whether they're married or single, de facto or married relationship, is it a good relationship or not, etc. All that sort of information does in turn reflect in how we design the estate plan. There's some ongoing business asset protection need for Wilma, given her role in the business community, and they want to set up things as tax efficiently as they can for the family, being the surviving spouse and the children. Now, Fred and Wilma, when they first came to see us, they liked the idea of simplicity, and they said, well, this is what we see happening with our estate. The very traditional style of estate planning, where assets are left to each other at first instance and then to the children equally. All very normal, all very straightforward. We tend to refer to this as the I love you will, colloquially. The first thing to note about the traditional approach, the traditional will, is it's all very simple. The second and perhaps most important thing to note is that it doesn't really achieve any of the objectives that we want to achieve. So as far as the second marriage asset protection is concerned, for example, Fred dies, assets are left to Wilma, Wilma dies, assets are left to Fred. If there is a new relationship for the surviving spouse, there's no asset protection there. All of the assets have passed to the surviving spouse. If there is a new relationship for the surviving spouse and that new relationship ends badly, then those assets are at risk. If there is a new relationship for the surviving spouse and it's a good new relationship, the surviving spouse may want to leave their assets to their children, but the new spouse has standing to make a claim on the estate. So there's a whole lot of risks there. Similarly, at the second level, when the assets are ultimately left to the children, again, there's no asset protection there from the family law perspective. So if there's breakups in any of the relationships for Pebbles or Bam Bam or Rock, there's no protection for those assets in the family law context. As far as Wilma is concerned, if Fred dies first and assets pass to Wilma, if she was to get sued in the business context, then there's no business asset protection either. Now, depending on the walks of life of the children, if Pebbles or Bam Bam or Rock are in circumstances where they also are people who may get sued in the business context because they're also company directors or they're doctors or lawyers or dentists or accountants or whatever the case may be, and they may have professional negligence issues, there's no protection for them either if the assets pass to them directly. So although the traditional approach to estate planning certainly is a simple approach, depending on the objectives sought to be achieved, it may not do anything in achieving those objectives. And hence, things like testamentary trusts are really, really common parts of estate planning in Australia. Very common and very effective to achieving a lot of the objectives that Fred and Wilma certainly have. Put very simply, a testamentary trust is a trust that somebody creates under their will. If Fred dies and leaves his assets into a testamentary trust that caters for Wilma and the children, the assets are not in the sole names of any of Wilma or the children, and so there's a higher level of protection. Now, depending on how we structure the testamentary trust, it can be a very, very high level of protection, or a medium level of protection, or a modest level of protection. But that's more the fine-tuning of things. Alternatively, because there's 3 adult children involved here, we may structure the estate with 3 testamentary trusts, one catering for Wilma and Pebbles and Pebbles' children, one catering for Wilma and Bam Bam and Bam Bam's children, and one catering for Wilma and Rock's children. And that's fundamentally because at the end of the day there's 3 kids and there's 3 lines of the family, and those 3 children may want to do things differently and have more autonomy over their own share of the inheritance rather than everybody being lumped into the one trust. Put simply, the testamentary trust is a very, very effective way to protect assets from the estate, including things that might arise in the area of family law asset protection and business asset protection. The testamentary trust can, of course, also be well used to protect in other ways. So one of the questions that was raised for today was the drug addiction that a child may have. Again, the testamentary trust is really effective to protect in that way. It can be designed to have appropriate people controlling that trust at the trustee level and also at what's called the appointor level. So the control officers can be chosen properly, and those officers will administer that trust for the benefit of the child with the addiction, be able to benefit that child by looking after their living needs and looking after any costs they may have for rehabilitation, etc. But the child is not going to be able to access the large capital base of the trust when they have those problems. Tax planning using a testamentary trust is also a really unique piece of the Australian tax law landscape. For many of you who have family discretionary trusts, you probably would have found that under the current tax laws, there's a penalty tax regime that exists for what's called unearned income of minors. And unearned income of minors includes things like trust distributions. That penalty tax regime has been in existence since 1980 and really hasn't changed very much since that time. This is a summary of that penalty tax regime and how it would compare to a testamentary trust regime. Estate beneficiaries in this example include spouse and, say, 3 young children. Now, under a normal family discretionary trust, the penalty tax regime applies to give the 3 young children a very low tax-free threshold of only $416. In the event that there is amounts above $416 distributed to a minor beneficiary, a child under 18, for example, that child is subject to penalty tax rates up to 66% on amounts up to $1,400, and then a flat rate equal to the top marginal rate on amounts above that. Compared to the testamentary trust, where the minors, the children under 18 years of age receiving distributions from a testamentary trust, are taxed at the normal adult tax rates. So currently they would receive the normal $18,200 tax-free each year, and then the normal marginal rates of tax above that. The difference to a family is significant. 3 times $18,200 versus 3 times $416 tax-free is a really significant difference and can be hugely valuable to a family in doing things like paying school fees for children or grandchildren. Now, these testamentary trust tax benefits arise not only where you're providing for your own children. All the law says is that the people who are receiving the distributions from the testamentary trust, they just have to be under 18 years of age. So the tax benefits could apply to your direct children who might be under 18 years of age, or your grandchildren who might be under 18 years of age, or your nephews and nieces, or simply the children of a friend. It doesn't much matter. But the point is, when you recognise who your intended estate beneficiary is, how is it best to set them up financially? This is a pretty good vehicle. In fact, it's a very good vehicle. And there's all the benefits of the asset protection as well. So henceforth, a preferred structure that we recommend for many, many clients in the right circumstances is this style of structure, where Fred and Wilma are creating 3 testamentary trusts under their respective wills. First trust will cater for the surviving spouse and Pebbles bloodline lineal descendants. The second trust will cater for the surviving spouse, Fred or Wilma, Bam Bam and Bam Bam's bloodline descendants. And the third trust would cater for the surviving spouse and Rock and Rock's bloodline descendants. So this is bringing forward all of the very good tax planning benefits of the testamentary trust, and it's also providing significant asset protection benefits at both the surviving spouse level and also at the child level. Now, part of the important structural features here is to say, well, that's the shell, that's the concept of what we want to do with planning the estate. As far as the nitty-gritty is concerned, who's going to control these trusts, i.e. who are the trustees going to be and who are the appointors going to be, and what does the beneficiary class look like? So for example, will the trustee of the first trust there be, if Fred has died, will the trustee be Wilma solely? Or will the trustee be Wilma and Pebbles jointly? Or will the trustee be Wilma and Pebbles and a third party jointly? Or will it be some completely different group of people? Control of the trust is really important from the protection perspective. If we want to achieve higher levels of protection, particularly in a family law context, we're not going to have the person at risk as the only controller of the trust. Really important decisions exist around here, and these decisions are often the subject of great discussion between the husband and the wife, and in conjunction with us, we reach a landing on what the right balance is as far as the structure of the various control offices. Now, the trustee office is the office that controls the day-to-day kind of decision making, including how to invest the assets of the trust, how to distribute the income and capital of the trust, whether or not to lend money to beneficiaries, etc. The appointer of the trust is the person who has a power to do two things: remove the existing trustee and appoint a new trustee if they need to, and also to deal with the succession of the appointer office, so to nominate somebody to succeed themselves to the appointer of the trust. Really important office. Both offices need to be thought through and need to be dealt with properly, particularly if we're wanting to achieve some high level of asset protection planning. The other really important structural aspect of the trust is going to be around the beneficiary class. So what does the trust look like as far as the class of beneficiaries that it's going to benefit? Are we going to benefit the usual broad class of people who are associated with the beneficiaries, the surviving spouse and children, including their spouses, etc.? Or are we going to be more narrow in the people that we want to benefit, specifically only the bloodline? So are we not going to include the new spouses of Fred or Wilma, the spouses of Pebbles, spouses of Pebbles' children? Are they going to be not included in the trust, or are they going to be included in the trust? These structural differences are important as far as the design and the level of protection that's going to be achieved. Now, sometimes there's particular issues that need to be dealt with around the house, as in the main residence house, superannuation and the family trust. Sometimes the thinking is a little bit different around those assets because there's some different attributes attaching to those assets. The house is a lifestyle asset most commonly, and it might be a very large value piece as well. It might be a very large chunk of the total wealth of the family, but it's a lifestyle piece. So when thinking about how to deal with the family home, what's the best thing to do? In the Fred and Wilma example, the home is in Fred's name. Should he leave that home under his will directly to Wilma? Fred and Wilma might have a chat about that, and they might say, well, yes, that makes sense, because if it's left to Wilma, house is in her name, there's no land tax liability each year then moving forward, there's a capital gains tax, main residence exemption that's obtained, and that all makes sense. However, there's no asset protection for the house either. So if there is litigation against Wilma, the house is exposed. So that's obviously a bad thing. Now, if the house is not such a valuable house, or if it's not such a valuable house in the context of the percentage of the total family wealth, it might not matter. But if it is a valuable house, and particularly if it's a reasonably high percentage of the total family wealth, then of course it might matter, because the risk to Wilma of losing that house through any litigation, maybe too high a cost to bear. So then we need to think about other things to do with the home, and that might be things like life estate interests in favour of Wilma with remainder interests to the trusts for the children, or it might be putting the house directly into the trusts. Now, both of those approaches have different implications as far as capital gains tax and land tax is concerned. Certainly if the house is in the trust, if all of the house is held by the trusts, then there's a land tax liability each year and a loss of the CGT exemption moving forward from the date of Fred's death. So market value at the date of Fred's death for the property is then the cost base for the trusts moving forward. And so any increase in value in the home from the date of Fred's death is then subject to the capital gains tax. The life estate arrangement, where Fred grants to Wilma the right to live in the property for the duration of her life, and then when she subsequently dies, Fred has also granted a remainder interest in favour of the trusts for the children, which means that it automatically reverts to the trust for the children. That approach is very common. There's no land tax liability in New South Wales under that approach, so that's a good thing. Still offers a high level of protection, which is a good thing. And the capital gains tax sort of sits somewhere in between. Probably not as good as Wilma owning the property in her own personal name, but better than all of the property sitting in the name of the testamentary trusts. So there's some balancing of objectives there. The superannuation is also an important asset to think through here because of the really valuable financial planning aspects that attach to super, particularly where there's a surviving spouse. In essence, surviving spouses are in a good position as far as superannuation death benefits is concerned because of all the concessional tax treatment that arises for them. If a person dies, if Fred dies and leaves his superannuation death benefit to his wife Wilma, then Wilma, being a spouse, is always a tax dependent on Fred and vice versa. And so the result is that those superannuation amounts can be received tax-free by Wilma if paid to her in a lump sum form. Conversely, of course, Wilma might say, well, I'd like to take some of Fred's death benefit in the form of a death benefit pension, because that's also a really good tax-effective income stream. Now, Wilma can do that under the superannuation laws, but she's subject to a cap, currently $1.7 million, that can be held in her pension account to draw a pension from. Now, if Wilma is not drawing a pension from her own super account at the time that Fred dies, Wilma can use Fred's account, Fred's member balance, to start paying a death benefit pension. If, for example, Fred's death benefit happened to be $1.7 million, then Wilma could start drawing on that $1.7 million and use that as, in essence, her transfer balance cap, her $1.7 million capped amount, and that would be her pension. She would then not be able to use her own member entitlement to draw a second pension because she's already got the 1.7 in her pension account from Fred's death benefit. But again, that's a very common thing to do because it maximises the amount that Wilma has in super, very tax-effective investment environment, and it provides a tax-effective income stream for Wilma. But Wilma is subject to the cap. Now, if Fred's death benefit is, say, $2.7 million, Wilma could only take 1.7 of Fred's death benefit in the form of the pension. What happens to the extra $1 million? Normally, you would want some flexibility there to say, well, maybe Wilma has the option to take that $1 million herself or to channel it into Fred's estate in order to fund the testamentary trusts, which may well be the next best tax planning environment and also offer some asset protection planning. There'll be different objectives here to be met, and death benefit nominations for the super fund often play a really important role here, be they binding death benefit nominations or non-binding death benefit nominations. The point is that that instrument, that death benefit nomination form, is often one of the critical things to deal with in structuring a person's superannuation death benefit planning in the estate planning context. Importantly, as far as the objectives for Fred and Wilma are concerned, remember one of their objectives was the second marriage asset protection piece. So if Fred's superannuation death benefit was very high and he died, say it was a $2.7 million amount, and he died, and Wilma says, well, I would like to draw the 1.7 in the form of a pension. If that extra $1 million goes to Wilma, there's no protection around that extra $1 million if she gets sued or new relationship that ends badly. Now, similarly, the 1.7 that is paying the pension, there's no protection for that either from the family law context, but there is in the business context. So if Wilma got sued in her role as the company director, there is protection for that 1.7 that is drawing the pension. However, there's not that level of protection, and in fact there's not protection for Wilma if there is the new relationship that ends badly. That 1.7 would still be counted as marital assets because it's part of her superannuation entitlements. Recall also that Fred and Wilma have an existing family trust. The existing family trust may or may not be important in the context of any particular family, because the family discretionary trust may or may not have a lot of assets in it. If it's got a large chunk of the family assets in it, then it becomes a more important piece of the puzzle, obviously. If it has a smaller level of protection, a smaller level of assets in it, then maybe it becomes a bit less of a focus for the family. In any case, the rules around here are simply as follows. The assets that are in the family trust are not the assets of Fred or Wilma, they're in the family trust. They don't directly get dealt with by the will because they're not owned by Fred or Wilma, they're owned in a separate entity in the trust. So from our perspective in planning the estate, it's really important for us to know what assets are in the trust, what are the values of those assets, and what does the trust deed say about this. At a very basic level, we need to know about those loan accounts that I mentioned earlier on, because if the value of assets sitting in the family trust is $100, but there are loan accounts owing to Fred or Wilma of $100, then really the net value in the family trust is negligible. There is value sitting in the estate because of the loan accounts. If, however, the value in the family trust is $500 and the loan accounts are only the $100, then there's a $400 net value in the family trust. So it becomes more important to look at the family trust then. Ongoing control of the family trust at a very basic level needs to be dealt with. So if we take the view that the family trust might be likely to continue to exist after the death of Fred and or Wilma, one of the things we need to look at is who's going to control that family trust. If Fred dies, is Wilma going to be the sole controller of that family trust? If Wilma dies, is Fred going to be the sole controller of that family trust? If yes, the position is not so strong from the family law asset protection perspective. If there's joint control with the children, the position is stronger. Similarly, in the business context, we might want to achieve a higher level of protection by having joint control of the family trust. Now, if Fred and Wilma both die, there's a certain logic in having all three of the children control the trust. Having regard, of course, to the characteristics of the three children. Are they, in essence, good children, mature enough, sensible enough to be able to run a trust? If yes, that's good. Do the three of them actually get on? And can they work together in running this trust? If yes, that's good. But if any of the answers to those questions are no, and the children are kind of not really capable of running the trust, or there's such frictions between the children that they don't really get on and they just can't be put together to run this family trust, then there's problems that can arise. And unfortunately, that's where we see a lot of family disputes arising, where the family discretionary trust has moved into the second generation, and there's now too many people controlling the trust. All of the children may be controlling the trust, too many to run it properly, differing views, differing needs from time to time. So one of the kids might have a whole lot of financial needs that the other two children don't have, and they may want to get a whole lot of money or assets out of the trust in order to help meet those financial needs. Reasonable suggestion, but the issue, of course, is how do they fund that? And from the other two children's perspective, do they want to fund that, and should they fund that? So frictions can arise within the family. One of the children may have some kids going through high school. They need some money out of the trust. They need more money out of the trust than the other two might do who have children going through primary school or may not have any children. So different circumstances for the children will sometimes cause frictions in the running of one single family discretionary trust. So we do sometimes need to build in succession planning measures within the terms of the family trust. Very importantly, how should votes be cast? So is there a risk of factions forming within the children and two outvoting the one, Bam Bam and Rock, gang up on Pebbles and elect to distribute all of the income to the two of them every year and none to Pebbles? They elect to pay themselves large directors' fees for being trustees on the trust, and they might make large loans to themselves and not to Pebbles. In a worst case scenario, bitter family frictions can occur there and bitter disputes can arise. Sometimes it's important to lock in the decision making so that all of the children have the right to have a vote, and decisions are often made by then unanimous resolution. And if there is no unanimous resolution, sometimes the best default position is just to benefit the children or their bloodlines equally, if that's the objective of the parents. So there's some important and quirky things that can arise with family trusts, particularly into the next generation. We tend to call this structure, where there's the three testamentary trusts, just out of interest sake, we tend to call this the I love you more structure. Remember, the I love you structure was the traditional will approach. So this is the I love you more structure. That's why there's so many hearts here. And that's because Fred and Wilma have given a lot more thought to their estate planning, and they really want to look after each other and their children much more than perhaps the traditional will might suggest. Now, before we move on to some questions, I'm just going to leave you with this one quote. Death is not the end. There remains the litigation. Unfortunately, there is a lot of litigation that occurs in deceased estate, and that's, I think, largely because of a number of reasons. As a general comment, there's an increasing level of wealth in the Australian community, if for no other reason than people have ridden the property market in the last 20 or 30 years or so, and the property prices have increased so much that suddenly lots of people's estates are reasonably large. People, I think, also as a general comment, are starting to get more and better financial planning advice, and so they're starting to have better superannuation balances. They're starting to have life insurance in the appropriate circumstances, again adding to the value of their estates. Also, we do tend to have a community in which there's a reasonably high divorce rate, and so there are a reasonably large number of blended family scenarios in the community, and the blended family scenarios do tend to cause difficulties. Lots of people to keep happy, lots of different types of beneficiaries at different stages of life. How is it best to provide for all of these people? So yes, lots of difficult and stressful things can happen in the world of disputed estates. Something to avoid if at all possible. Keeps our deceased estate litigation team extremely busy, I might add. Okay, so hopefully that was an interesting run through of a lot of essential principles of estate planning. As I mentioned, there were a lot of questions that were sent in prior to the presentation. A lot of the questions did centre on some really common themes, and there were some very consistent themes in a lot of the questions as well. Some of those questions and themes have been covered a little bit in the comments that have been made up to now by Belinda and myself. But we thought we might just in this session now, just dealing with some questions, I'll just try and cover off some of the more regularly asked questions. So one of the questions that was raised was about dealing with assets prior to death. In essence, should I be distributing any assets or transferring any assets to my children now before I die? Now, look, there might be a good reason to do that, but you really do have to ask yourself, why am I doing that? What is the objective that I'm hoping to achieve with that? And how important is that objective? Because there are some downsides to that. Now, if I owned a property, for example, and one of my estate planning objectives was to transfer that property to my daughter. Now, because she might live in the property and use it as her main residence. Fantastic. If I do that under my will, there's a whole lot of tax concessions that exist. If I do that under my will, there are no capital gains tax implications, except for certain assets that may be passing to non-residents. So there's a few exceptions to this rule, but the general rule is that when assets pass through the estate of an Australian resident person to an Australian resident beneficiary, there's no capital gains tax event that occurs. So that's good news. There's also concessional stamp duty that is paid, only $50 on real estate passing through an estate in accordance with the terms of a will. So in my example, where I transfer an asset, being real estate in this example, to my daughter, if I do that under my will, no capital gains tax implications and no $50 stamp duty. If I do that during my lifetime, unless it's my main residence, capital gains tax implications will arise for me, and also stamp duty liability will arise for my daughter, which I may end up paying, but there's a stamp duty liability that arises. So the desire for me to get that property to my daughter may come at a really significant cost. Why am I doing that? Is there a need to do that? What objective am I trying to achieve? Well, do I want to pay all that money just to get the house to her now, rather than in the event of my death? It could be a very large cost to pay. Sometimes it might be worthwhile paying the cost. If I was very concerned about a challenge being made on my estate, one of the ways that is commonly looked at to defeat a person making a claim on the estate might be to minimise the size of your estate. If the only asset that I had in my estate was that property, and I wanted to leave that to my daughter, who was very close to me, and I was concerned about a challenge being made against my estate by my son, who, because we'd had a falling out some years ago, and I didn't want to leave him anything under the will. If I died and left my estate to my daughter, being that property to my daughter, it's possible that my son might challenge the will. It's possible that he might win the challenge, and therefore the estate planning objective might not be achieved. So I might end up saying, well, maybe I do. Maybe the cost is worthwhile paying in order to minimise or eliminate the risk of a successful claim being made against my estate. Big question though, and really big cost potentially to pay. If the asset is not property, but if the asset is a share portfolio or shares in the family company, the implications are different again. The capital gains tax implications might be quite different. If it's a broad, diverse listed portfolio of shares, there may be capital gains on some, capital losses on others. The overall capital gains tax exposure may not be so great. And there may not be, or there's no stamp duty implications on the transfer of shares. So the costs might be much lower. Therefore, might be a good thing to do if there was that risk of a claim being made on my estate. Again, we come back to the basic principles, understanding the nature of the asset holding, understanding who the beneficiaries of the estate are, who you want to benefit from the estate, and what your estate planning objectives are. That will help answer a lot of these questions. When it comes to challenging an estate, of course, in New South, the laws about challenging an estate are different. They're state-based laws and territory-based laws, so they're different in Victoria versus New South Wales versus Queensland versus South Australia. If we live in New South Wales, there is rules around what's called prescribed transactions and notional estate rules. Now, these rules, in a very basic description, say that if I have transferred assets out of my name to somebody else or to another entity, and if I have done that within 3 years of the date of my death, then if the size of the estate is not large enough to satisfy a successful claim on my estate, those assets that I transferred out of my name can potentially be clawed back into what's called the notional estate in order to satisfy the claim made by the successful plaintiff. So in my example earlier, if I had decided to pay the CGT and pay the stamp duty and transfer the property to my daughter to achieve my estate planning objective, and I died within 3 years of doing that, and my estate consisted of nothing, and my son made a claim on my estate, he may well make as part of that claim a claim on my notional estate, which was the value of the property that I had transferred out of my name, because I had died within 3 years of making that transfer. New South Wales is the only jurisdiction that has that particular law. So all these things need to be considered in basically thinking about, should I be making these asset transfers before death or not? If the only reason that you're making the asset transfer is to minimise the value of the estate to save on the costs of probate, or to save on the time period that it takes to administer the estate, well, I'm not sure that that's always the best approach, because the other costs, the tax costs, may be just far too great. And of course, you may well be missing out then on the benefits of the testamentary trust and the ongoing tax planning benefits of that, and the asset protection benefits of the testamentary trust as well. Sometimes, however, there might be useful reasons to deal with assets pre-death. So in an unusual scenario, but if I happened to know that I was dying and I had no dependents, then I might want to withdraw all of my super. Because if I have no dependents, then there'll be if I have no dependents and I die and my superannuation death benefit gets paid to, say, my adult children who are not dependent on me, then there'll be a taxing point there. There'll be a tax of 15% plus Medicare on the taxable component of my death benefit. Now, if that's a large number, well, that potentially could be a problem. If I knew I was dying, and if I took that money out of my super fund before I died, then the money is coming to me as the member, assuming I can access it, of course, at that time because I've reached a certain age. It's coming to me, so there's no tax then on that. And then I can distribute it through my will if I want to the testamentary trust that would be established under the will, or I could just give it to my children if I wanted to. So yes, there might be some reasons to access super in that context, but I just advise you to think carefully about dealing with assets pre-death and make sure you're making a fully informed decision about that. One of the other questions, or many of the other questions that were raised, were around family discretionary trusts, and the use of family discretionary trusts and how they interact with and relate to estate planning. Now, we have touched on that a little bit earlier in the Fred and Wilma example, where we looked at the potential ongoing frictions and problems that might arise in a family trust when it is controlled into the next generation. So as a general comment, yes, recognise that the family trust is not you. The assets in that family trust are not yours. They won't necessarily be dealt with by your will. The trust would have to collapse and be paid to your estate to be dealt with under your will. Now, if the trust collapses, as in terminates, then the movement of those assets out of the trust to your estate is, again, a CGT and potentially stamp duty event. So there's, again, lots of implications and lots of potential costs in collapsing the family discretionary trust, potentially, depending entirely on how the trust is invested at that time. If it was invested only in cash at the time that the death occurred and the trust collapsed, well, there wouldn't be any of those tax costs. But anyway, the point is that in dealing with the family discretionary trust, it's not yours, and we need to think a lot about the succession planning around that. Who's going to control the trust when the first spouse dies? Who's going to control the trust when the second spouse dies? What does it look like when the children come to control the trust? Should the children be the controllers? Should other people in conjunction with the children be the controllers? Do the children get on? Is it going to cause frictions? Do we need to do something different as far as the voting for the children is concerned, i.e. impose unanimous voting requirements on them, give all the children the right to be a trustee and to actually get a seat at the table, so that there's not going to be a question of, well, 2 of the 3 children will outvote 1 and kick them off the trustee table? And do we want to impose a forced equal distribution of assets through the trust in the event that there is no unanimous decision making? Also, questions arise with the family trust as to just how consistent it is with the overall estate planning. A really common area here where it is almost never consistent is in the family tragedy scenario. So if there was the family tragedy event that killed all of the main people that we wanted to benefit under the estate, so it kills Fred, Wilma, Pebbles, Bam Bam, Rock, all the grandkids, everybody has died in the one event, it's common for a will to deal with those circumstances and to say, well, who would you like to distribute the estate to in those circumstances? Where would the estate be distributed? Now, there's not necessarily any right or wrong answers to that question, but the will makers will typically say, well, I have other family members that I would like to distribute the estate to them, my brothers or my sisters or my nephews, nieces, etc. Or there's these charities that I support that I would like to distribute to. Uni of New South Wales I would like to distribute to, or some proportionate combinations thereof. It is almost certain that the family discretionary trust deed will not say that. There'll be some inconsistency there. And so if a great deal of the family wealth sits in the family discretionary trust deed and the family tragedy event occurs, the objective for the estate planning is not going to be achieved. So in many ways, we do need to be really mindful of family discretionary trusts, treat them a little bit differently, and really get into the detail of those trusts. It is important to look at the financial accounts for the family discretionary trust to say, well, what's the position with things like loan accounts? How are they going to be dealt with under the will? Because the loan accounts, if they're owed to me from the family trust, that is indeed an asset of mine that will be dealt with under my will. And for that matter, what do the loan accounts vis-a-vis the children say? So if there's been what's called unpaid present entitlements building up over the years in favour of the children, how are we going to deal with those? And are they equal or not equal? So if there is an unpaid present entitlement for Pebbles of $100, but the unpaid present entitlement owing to Bam Bam is $1,000, there's a mismatch there. Bam Bam and Pebbles may well want that money to be repaid to them, but is it right or is it fair that Bam Bam is getting 10 times the amount from the trust that Pebbles is getting? Or is that really just an aberration because of the way the trust has been administered? So the financial accounts are pretty important in family trust context. Many of the questions that were asked also involve the circumstances of the intended beneficiaries and protection of assets. I think I mentioned earlier there were some questions raised around how do I protect the assets that my child might inherit from a breakup in their relationship. And I think we've covered a little bit around that. It is possible to protect the assets in a family law context by using a properly designed testamentary trust under the will, rather than have the child inherit the assets in their own name personally. Importantly though, there's lots of things to consider, including who's going to control that testamentary trust and who's going to benefit from that testamentary trust. And there's all sorts of levels of protection that can be achieved. But very importantly, we need to think carefully about control of the trust, because if we do want to achieve a high-ish level of protection, then the person who is at risk should not be the only person controlling the trust, especially if they're also going to be a beneficiary of the trust. Control and benefit are the two really important levers to consider here. So if the person at risk is going to be the sole controller of the trust, that might weaken the position of protection, particularly if they're also going to be a capital and income beneficiary of the trust. If the person at risk is not going to be a capital beneficiary of the trust, big step to take. So your child, for example, you might say, well, they can be an income beneficiary of the trust, but they're not going to be the ones who will get the assets of the trust. The trust is really for the grandchildren. Big step to take, big decision to make. It might be appropriate for the child to be the only controller of the trust in those circumstances, but we have to get the balance right here. In designing the class of beneficiaries, we need to look at carefully who will be the income beneficiaries, who will be the capital beneficiaries, and do we need to exclude specific people from benefiting from the trust, i.e. the in-law that you particularly dislike, or do we just need to exclude more generally a class of persons, so any in-laws of any of the beneficiaries from time to time. All very important decisions, and it's not a one-size-fits-all kind of thing. So for lots of families, they're not immediately necessarily going to go down the path of family law asset protection, but for some it's really important to do that, either in a very specific sense because of a poor relationship with one of the intended beneficiaries, or just in a general kind of sense. My child has a great marriage, but just in case it breaks up, what can I do about it? So there's some important decisions around that, some of which I think we've touched on a little bit earlier in the case study. There were questions raised also around the business asset protection needs, and the same sort of principles flow in there as far as the design features for the testamentary trust is concerned. Who's controlling the trust and who's benefiting from the trust? What does access to the assets and income look like as far as the beneficiary class is concerned? There was also questions raised in the international context, and these questions said, well, what if I own assets overseas? Do I need a will in that foreign jurisdiction? And what if my intended beneficiaries are resident in a foreign jurisdiction or citizens in a foreign jurisdiction? All very complex implications here. The first thing about owning assets in a foreign jurisdiction is it's always important to get advice in that local jurisdiction. It is certainly possible that the Australian will may well be recognised in the foreign jurisdiction. Now this is quite common with Commonwealth-based countries, England, Canada, New Zealand, etc. Quite common, and it's also common to go through what's called a resealing process, whereby if I own property in the UK, for example, but I'm an Australian domiciled person, and I die in Australia, probate of my will is granted in New South Wales. I can therefore deal with all of my local assets in this New South Wales jurisdiction, but I then need to get my will, what's called resealed, in the UK jurisdiction to deal with the assets that I own in the UK. So it's a cumbersome exercise. It's sort of two lots of the same/similar sort of process, but can be done. So the Australian will is recognised in the UK, for example, and will be treated as valid. That may not necessarily be the case in non-Commonwealth based countries. So countries in Europe that are not based on English law, based on canon law, Italy, Spain, Germany, will have different laws as far as recognition of wills is concerned. So we need to get local advice in those jurisdictions. Also, for some assets in other countries, the will might not actually be a relevant thing. They might have what's called forced inheritance laws, where the law says what's going to happen with the land that you own in this particular country. The law says this is how it goes. It goes to your spouse, or it goes to your children equally, or it goes to whoever. The law will actually dictate what happens. The will won't be able to override that. So yes, local advice is really important. Also because there may be planning issues that need to be addressed in that local jurisdiction. So that local jurisdiction may have a death duties regime, and you might be caught up in that death duties regime because even though you're a foreign resident, as in an Australian resident, foreign to that other jurisdiction, the assets that you own in that jurisdiction might nonetheless bring your estate within that death duties regime. Now, there may be planning things that need to be done to overcome that, if possible. All very difficult or very complex issues, but a need to get local advice. The status of the intended beneficiaries as being residents in different jurisdictions also gives rise to complications. Now, those complications might arise because the son or the daughter is residing in a foreign jurisdiction, or they may have citizenship in a foreign jurisdiction. A lot of foreign jurisdictions do have death duties and inheritance tax regimes, and those regimes might trigger because of either citizenship, such as the US, or because of residency positions, or both, of course. So when we know about the status of the beneficiaries, and we know that, yes, I'm an Aussie citizen, but my spouse is a dual Aussie and US citizen, and my kids are all dual Aussie and US citizens, when we know that level of detail about the family, that immediately rings alarm bells to say, well, we need to ideally get some US advice on this because of all the citizenship issues. The citizenship is something that links back to the US tax regime. I think it's one of the few, if not the only regime that in the world that uses citizenship as a link back to their tax net. Most jurisdictions use residency or source. So our tax system is based on fundamentally source and residency, source of income and residency of the individual or the entity to bring it within the tax net. The US also uses citizenship. So you could be resident in Australia for many, many, many years, but still hold US citizenship. You're still linked back to the US. Your kids may be resident in Australia for many, many years, but hold US citizenship, links them back to the US. Not only for income tax reasons on a year-to-year basis, but also in the whole area of US estate tax. Now, again, not surprisingly, with today's global community, there are lots of families with assets all over the world, and also family all over the world. And there's lots of reasons that do tend to pop up to say, well, we need to get local advice from foreign jurisdictions because this family's circumstances are a little tricky and a little difficult. As far as the US is concerned, we have been fortunate enough to deal with some really good US lawyers who have helped us out on lots of clients over the years. And again, properly structured testamentary trusts can be a very effective way to help protect against the US estate tax issues. There were questions raised around superannuation death benefit planning. Again, not surprisingly, lots of families, lots of clients have contributed a lot to super over recent times, particularly with all the government incentives to do so. And so for many people, super balances are reasonably high. And so there's a lot of concern and a lot of desire to deal with their super balances in a sensible way in the estate planning area. And again, I think we've covered a reasonable amount of this earlier on in the case study, including comments around the payment of pensions, and taxing points as far as non-tax dependents are concerned. The use of binding death benefit nominations is really important, even in a very basic level. It's important to say, well, if there's not going to be any challenges on my estate, how can I be certain that I want to get my superannuation death benefit to all of my children equally? You make a binding death benefit nomination in favour of your children equally. If there's not going to be any challenge on the estate, then the nature of the binding death benefit nomination is that the trustee of the super fund must follow that direction. So even if only one of your children was the trustee of your self-managed super fund, because maybe that child happened to be a member of the fund with you, but you wanted your death benefit to go to all three of your children equally. Binding death benefit nomination in favour of all three of the children equally. Your one child, who is the surviving trustee of that trust, of that super fund, must follow that binding death benefit nomination. Otherwise, they would have a discretion as the trustee to pay your superannuation death benefit amongst the relevant class of potential beneficiaries, which would include spouse, if there was a spouse, children, somebody who was financially dependent on you, or the estate. So if your child who was the surviving trustee of your super fund happened to be a bit of a rogue and decided to pay your death benefit all to themselves, theoretically they have the power to do that under the superannuation laws. They're the sole surviving trustee of the super fund, and they're an eligible person who could receive that death benefit. That could cause some problems within the family. The other two kids might have to then make a claim on the estate to reverse that decision. So binding death benefit nominations can be really important and really useful in the area of superannuation death benefit planning. But again, when you come back to the basic rules, you look at what is the value of my death benefit, who are my intended beneficiaries for that superannuation death benefit, is it spouse or children or estate, and how is it best to get to that end result. Now sometimes, where there's challenges that may happen in an estate, sometimes death benefit nominations are not necessarily going to be the best thing to do. They can also be challenged. So it's possible for somebody to make a claim on the estate and say, well, Andrew left his superannuation death benefit to his son, but the daughter making the claim might say he should have left some to me, and he could have changed his death benefit nomination at any time prior to his death. And so the claim may be based on that sort of argument. So sometimes where there's risks of challenges being made against an estate, simply using binding death benefit nominations may not be enough. We may need to actually look to the terms of the super fund deed. One of the other important questions, in fact many of the other important questions, revolved around challenges to estates. And a really common good question. If a will is written by a person of sound mind and under no duress with the advice of a solicitor, can it be successfully challenged by any of the children of the deceased? Really sensible, practical question. The first point to make about this is, again, the rules about challenging estates are state and territory-based laws. So the laws in New South Wales are different to Victoria, are different to Queensland, different to South Australia, etc. So they're state-based. Now, if I'm in New South Wales, it's fundamentally going to be a New South Wales based issue. If I am domiciled in New South Wales, but I own property all over Australia, I might need to consider the other jurisdictions as well, because the other jurisdictions might well be relevant as far as claims being made. My disgruntled beneficiaries may make a claim in a different jurisdiction in Australia seeking to attack the assets that are in that jurisdiction if they feel that they have more chance of success in that different jurisdiction. All very complicated litigation issues there. But the first point is we've got to know the jurisdiction that we're dealing with because they are state and territory-based laws. The second point is to understand who in the appropriate jurisdiction actually has standing to make a claim on the estate. Now, New South Wales, for example, has certain people who are called eligible persons who have standing to make a claim on an estate. It doesn't mean that those people will win the claim. It just means that they can get up to the starting blocks. They have standing to make a claim. A spouse is somebody who has standing to make a claim on an estate. So my spouse has standing to make a claim on my estate. Ex-spouses have standing to make a claim on the estate. Doesn't mean they necessarily win, but they have standing to make a claim. Children have standing to make a claim. People who are financially dependent on a deceased person have standing to make a claim. People who are grandchildren and who have lived in the same household as the deceased person also have standing to make a claim. So against that background, for some, that kind of eases a whole lot of stresses. There was a question asked about my brothers and sisters. I don't get on particularly well with them, and I want to leave my estate in the way I want to leave my estate, but I'm concerned about my brothers and sisters making a claim on my estate if they're unhappy. Now, in New South Wales, the brothers and sisters don't have standing to make a claim on your estate unless there is some financial dependency that they have on you. So for many, that's just going to ease the stresses straight away. My brothers and sisters, completely independent from me, no financial interactions that I have at all with them. So that's fine. I can leave my estate to whoever I want to. They don't have standing to make a claim in New South Wales. If, however, that person died without a will, and say that their parents had died, the New South Wales laws then set out a next of kin, if you like, pecking order of people who will inherit the estate of somebody who dies without a will. So if you die without a will, the law says where the estate's going to be distributed. If there's no spouse, if there's no children, if there's no parents, brothers and sisters are the next in line as far as the pecking order is concerned. So they would then receive the estate of that person who died without the will. But if the brothers and sisters don't have any standing to make a claim, and the person actually makes the will and says, well, I would actually like to benefit my friends, or I would actually like to benefit these charities that I support. Great. They can do that in their will, and the brothers and sisters won't have standing to make the claim. So really important to understand just who can make the claim. Now, if we assume that there are some people who can make a valid claim, and that might be a spouse, it might be children, it might be spouses or children in a blended family kind of scenario, where even though you feel like you're doing the right thing and trying to look after everybody, there may still be people unhappy. They're still children and they have standing to make a claim because the 25-year-old from the first marriage hasn't been treated in the same way as the 5-year-old from the second or third marriage, and they say, I feel unhappy about that, I'm going to make a claim. So there's potentially some issues that arise there, obviously more complex and difficult things to deal with. But we need to understand then, yes, there's these people who can potentially make a claim, but what are the courts actually going to be looking at when they come to consider this, assuming it doesn't ever settle? And the law sets out what the courts need to consider. There's, I think, 11 conditions, 11 elements to the section in the Succession Act that talks about what the courts take into account. And the last of those sections is all other relevant facts and circumstances. So it's a pretty broad thing. They take into account all the relevant facts and circumstances, including the nature of the relationship between the person making the claim and the deceased person, whether it's a good relationship or a bad relationship. If it has broken down, how long has it broken down for, and the reasons why it broke down. They have regard to the value of the estate, and importantly, they have regard to the financial needs of the person making the claim and the financial needs of the other beneficiaries of the estate. All difficult sorts of questions to answer. But when we're looking at planning an estate in order to defend a claim being made against the estate, all this stuff is really, really important, because it will often affect what we do as far as trying to minimise the risk of claims being made, or the risk of successful claims being made in particular. Sometimes something as simple as a statement of reasons will go a long way to fending off a claim, because a statement of reasons is going to be a statement by me as the will maker, setting out to the world at large, including the court if it ever needs to go into evidence, why I have done what I've done in planning my estate, what the true relationship is between myself and my son or my daughter who may be making the claim on my estate, why that relationship is what it is like, when did it break down. I can give all the details about that, the reasons why it happened, how our relationship hasn't mended over the time. I can give all this information, the level of support that I've previously provided, etc. All these sorts of things will be extremely relevant in basically providing evidence to support a case at the end of the day. However, we may need to go steps further. We may need to minimise the risk to the estate by taking assets out of my estate. So doing things like redirecting superannuation entitlements away from the estate. We may need to move assets into family discretionary trusts during lifetime. Yes, capital gains tax and stamp duty implications, as was mentioned earlier. Yes, in New South Wales there's a 3-year relation back rule for national estates, but that's all just part of the planning. So we need to take those into account and ultimately make a decision, is this worthwhile doing? Now, I mentioned that all these laws on challenging estates are state-based and territory-based laws. So sometimes there will be more generous provisions in different jurisdictions. So if we felt that New South Wales was a bad jurisdiction for me to be domiciled in and dying in, then it may be that I can move to a different jurisdiction so as to shift the jurisdiction in which the claim needs to be made away from New South Wales to that other jurisdiction, because that might have a better outcome. Really big step to take. It's a lifestyle step to take. But again, depending on where the priorities sit and how important all this is in the judgment call, well, at least it's an avenue that can be worth considering. And there were also some very practical questions that were raised. A couple of those practical questions are, I have assisted my daughter into the property market. How does this impact on my estate planning? So sometimes parents are very generous and they do help their children into the property market, or not just for property, but for any reason for that matter. They might provide some financial support to them in order to do that. They might make a loan to their daughter in this case to help her buy a home, or they might simply gift her some money to do that. Important differences there. As a general comment, if you're wanting to potentially protect that money, in case your daughter's relationship breaks up, then you would want to loan her that money rather than gift her that money, so that you can claw it back if you ever need to. So importantly, loan agreements should be put in place to evidence that as a debt, not as a gift. In the estate planning context, that debt that your daughter owes you is an asset of yours. It needs to be dealt with under the will. What we then do with that under the will is a question for planning. If we left that debt to your daughter, then it would extinguish, because your daughter would owe the debt to herself and the debt would be extinguished. If, however, we left that debt to a testamentary trust for your daughter, then that's, as a general comment, a better thing to do, because it preserves the asset protection. Your daughter still owes that debt to a friendly protective entity. And it also is a way of getting further funds back into that testamentary trust for further investment purposes. The question then also pops up, well, what then do I do with my other daughter or my son who I haven't provided that level of support for? So sometimes in the will also there's a need for equalising clauses to basically even things out in the will. There was a question around remarrying and whether I need to do anything about my will because I've remarried. So short answer is yes, because fundamentally the remarrying does cancel your existing will. So marriage revokes a will. Whether it's a first marriage or a second marriage doesn't matter. Once you get married, after you've made a will, that marriage revokes any previous wills. So yes, that's very much a trigger point in life to say, well, I need to revisit my estate planning now. In a practical sense, though, it also makes sense to do that because you have this other person in your life now, and you need to go through the thought processes to say, well, do I feel like I want to provide for this person? Or if I have children from prior relationships, are they still my priority? I might want to provide for this this new person in my life, my new spouse, in a particular way. Terrific. If I don't want to, they have standing to make a claim on your estate now. So how do you both feel about that? Do you want to agree not to make a claim on each other's estate? Because your new spouse, he or she, may also have children from the prior relationship, and so there may be some parity on both sides of the fence, but equally there may not. So yes, the blended family scenario raises a whole lot of complex questions as far as how to benefit intended estate beneficiaries, and often the priorities in benefiting different estate beneficiaries, and sometimes also how to benefit different estate beneficiaries with different assets. By common scenarios that arise there, the family home that the husband and wife live in, lifestyle asset. If my children from my first marriage were, say, older adult kids now living out of home, logically there may be some sense in the home being part of the inheritance for the new spouse. Superannuation, as we've seen, have certain benefits attaching to it from a tax and financial sense if that is paid to a surviving spouse. If I had a family discretionary trust that held a whole lot of assets, if that family discretionary trust predated my relationship with my new spouse, then again, there may be a certain logic in saying, well, I kind of feel like those assets in that trust really belong to the children from my first marriage. There may be some logic in all of that kind of thinking, but the numbers may not play out that way. So what's the value in the family trust that's going to the kids? What's the value of the house and the super that's going to the new wife? The numbers may just not stack up at all. Difficult questions, but also things that need to be thought through and ultimately planned for. There was a question raised about wanting to leave my estate to. I had two brothers, and one of my brothers died and left a spouse and one child, but my other brother is still alive and has a spouse and 3 children. How do I deal with that? What is the right thing to do as far as benefiting those families are concerned? Now, again, on the basis that, if you took a fairly clinical kind of view of that, on the basis that the New South Wales law applies and neither of the families there have any standing to make a claim on your estate, then on one view, it doesn't matter. You can do what you want to because nobody's got rights to make a claim, assuming you don't have a spouse in this example. Or assuming you don't have a spouse and no children either who would otherwise have standing to make a claim. But of course, if you looked at this from a fairness perspective, I mean, really, the law doesn't particularly care too much about fairness. It's simply concerned about who's going to make a claim and, have they been properly provided for. In those circumstances, though, all I can say is common approaches are to say, well, if I loved both of my brothers equally, maybe I should do a 50-50 split. That's one approach. Or another approach is simply to go to the nieces and nephews level and to say, well, I don't really control how many children my brothers had or have during their lives, and so I might just benefit all of my nephews and nieces equally on a per head basis. Really, no right or wrong answers to that, but they're just two common approaches that are sometimes adopted. Just a couple of more really practical questions that that were raised by the audience prior to the session. What are the problems with writing my own will? Well, of course, you can write your own will, but sometimes the problems that arise there are that you don't address all of the issues. And so, as you've seen today, potentially there can be a lot of things to think about and a lot of planning to do, and you may just not address all of those issues properly in the will that you write yourself. It's also possible that the drafting may just be wrong, and we do certainly have experience where there's handwritten wills made and they're in essence too uncertain. They're void for uncertainty because they haven't dealt with particular assets of the estate. There's no what's called gift over provisions if the gift fails. So sometimes there's just a lot of uncertainty because of the lack of more skilled or more experienced drafting that goes into the document. It is important to update your will. One of the other questions that is raised. Every so often you should think about the contents of your will. Have your circumstances changed? If yes, you should revisit it and think through what to do. It is good to take advice on that because it just helps gel the questions that you may have and can provide some guidance there. But of course, some of the things that have changed in the intervening time, the lawyer would need to know about. So if your circumstances have changed, you need to be really upfront and open and transparent with all of the changes in your circumstances so that you can get proper advice. Now, the cost of keeping the will updated is really the cost of meetings in conference with the lawyers to discuss those changed circumstances and what might need doing, and then the cost of any changes that actually need doing to the will. So for many of our clients, they'll come in every couple of years or so, sit down for an hour and go through their estate planning documents, talk about the changed circumstances that they may have. Everybody's memory gets refreshed as to the structure of the estate planning, which is really good and really important for everybody. And there may not be any changes at all that need doing. But it's an hour well spent. Everybody's back on the same page, and we can tick the box again for the next short period of time until the next review comes along. So personally, I think it's a very worthwhile exercise. Wills don't get registered anywhere per se, but it is important to know where your will is and to basically tell the right people where your will is. So it's not like there's a central registry for wills. But if you keep your will with your solicitor, for example, as a general comment, it is good form to advise your children, say, or the people who are the executor of the estate, where your original will is held. You don't have to give them a copy of the will, of course, but at least where the will is held, just in case something does happen to you, at least they know where to go. And yes, of course, as we've touched on, dying without a will, the different states and territories will set out their own laws as to what happens in that scenario, called the intestacy laws. So if you die intestate without a will, the law basically tells you what's going to happen to your estate. Different jurisdictions have different rules in that way, but common orders are for the spouse. An order of people would be for spouse to receive the estate. If no spouse, then children. If no children, then brothers and sisters, then nephews and nieces, etc. So that's broadly what the New South Wales rules say. Different in blended family scenarios where the children are not children of the current spouse, then there's a split between the current spouse and the children from prior relationships. So a little complex, but certainly worthwhile knowing, because it will often tell you, well, I don't really want that result because it's not achieving my objectives, so I do need to prepare a more sophisticated will. Ladies and gentlemen, I think I might leave it there. Thank you very much for your attendance today.